We're going to tackle a huge financial question that honestly so many families are facing right now. How in the world do you handle the massive costs of senior care? Most people just assume that the biggest chunk of that monthly bill, the part they call rent in assisted living, is just a personal expense you have to eat. But what if I told you it wasn't? What if a specific IRS rule could turn that rent into one of the biggest tax deductions you've ever seen?
Okay, so let's break this down. On one side of the screen, you've got the brutal reality of senior care costs, which can easily blow past $100,000 a year. It's just staggering. Then, on the other side, you have the new tax rules coming in 2026. Thanks to some recent law changes, the standard deduction is at an all-time high, which sounds great, but it actually makes it way harder for most folks to get any benefit from itemizing expenses. You see the problem? We've got these huge, unavoidable costs crashing into a tax code that's making it tougher to get a break.
And that's the big question we're digging into today. What if there was a way to flip this whole thing on its head? To take those enormous care costs and use them to your advantages? A way to turn what feels like just another bill into a powerful tool that could, literally wipe out your entire federal income tax bill. Well, it's possible. You just have to know the rules of the game.
So here's how we're going to get there. First, we'll look at that new 2026 tax hurdle. Then, we are going to uncover the single most important part of this whole strategy, what the IRS calls being chronically ill. We'll use memory care as a perfect case study. After that, we'll get super practical with an action plan, the exact documents you need. And finally, we'll run the numbers so you can see just how big of a deal this really is.
All right, let's kick things off with Part 1, the 2026 tax hurdle. And believe me, this isn't just a few minor tweaks. A new law has totally changed the math for senior taxpayers.
So let's look at how these new deductions really stack up. For a married couple, both over 65, you start with the base standard deduction. That's $32,200. Then, you tack on the usual age add-on, which gets you another $3,300. But here's the real kicker. There's a new senior deduction. It adds another $12,000 for the couple. So you add it all up, and you're looking at a huge hurdle of $47,500. That's how high your itemized deductions have to be before you see a single penny of tax savings from them. And this really shows you the two sides of the coin here. For your average senior couple, that nearly $50,000 bar makes itemizing pretty much pointless. But for a family shelling out, say, $100,000 a year for memory care, suddenly that $47,000 bar is easy to clear. The sheer size of long-term care costs creates this really unique opportunity. So the real question is, how do you make absolutely sure those costs qualify?
And that leads us right into Part 2. And folks, this is the absolute heart of the strategy, the chronically ill key. This is the legal trigger that completely changes how the IRS looks at your assisted living bills. You see, the IRS has a default setting. On one hand, they see a nursing home as a medical facility, kind of like a hospital. They just assume you're there for medical reasons, so everything, the room, the meals, the care, it's all deductible. But they see assisted living totally differently. They assume you're there for personal convenience, help with meals, cleaning, just having company. So, by default, only the little sliver of your bill that's specifically for medical care is deductible. The thousands you pay for rent and food? Nope. Our entire goal is to flip that switch. And this is the legal key that does it. It's right there in the Internal Revenue Code, Section 7702B. It gives a very specific definition of a chronically ill individual. If a resident meets this standard and gets formally certified by a doctor or nurse, the game changes. The IRS can't just call it a personal residence anymore. For tax purposes, that facility now becomes a medical institution for that person. And that means the entire cost, room and board included, can become deductible.
So, how do you get certified? Well, there are two clear pathways. The first is the physical path, called the ADL test. This is for someone who can't do at least 2 of 6 specific activities of daily living without what the IRS calls substantial assistance. The second path is a cognitive one. This is for someone who, because of something like Alzheimer's or dementia, needs to be supervised constantly, just to keep them safe.
Let's take a quick look at those activities of daily living, or ADLs. The IRS is very specific about these 6: eating, toileting, transferring, bathing, dressing, and continence. And transferring, for example, doesn't just mean walking. It means being able to get from a bed to a chair. The real key here is needing substantial assistance with at least 2 of these. And that can be hands-on help, or it can even be just standby assistance, meaning somebody has to be right there, ready to step in to prevent an injury. This brings us to Part 3. Now, to see just how powerful this strategy is, let's look at the clearest possible example: a resident who's in a memory care unit.
And look, this isn't just some clever loophole we found. It's a strategy that's been tested and upheld in U.S. tax court. In a really important case called Estate of Baral v. Commissioner, the court set a huge precedent. They ruled that when someone needs supervision because of a medical condition, like dementia, that supervision is medical care. It's not a lifestyle choice, it's a medical necessity to keep them safe.
And the result of that ruling is, it's just massive. For someone in a memory care unit, the main reason, the principal reason they're living there is for that 24/7 safety and supervision. And because of that, the entire cost of being there, the room, the food, everything bundled into that monthly fee is now considered a deductible medical expense. It completely transforms the biggest part of your bill from a personal cost into a medical one.
Okay, so we get the theory. Now for part 4, the practical, boots-on-the-ground action plan. This is all about getting your paperwork right. Because let's be honest, in the world of the IRS, if it's not on paper with the right language, it basically didn't happen. This is where the strategy becomes actual savings. All right, the single most critical document you need is the plan of care. This is not optional. It has to be a formal, written plan that's been prescribed by a licensed professional, a doctor, a registered nurse, or a licensed social worker. A quick scribble on a prescription pad won't cut it. And here is a huge pro tip from the research. Do not just rely on the assessment that the facility does internally. Go get an independent letter from your loved one's own doctor. This gives you a much stronger, unbiased piece of evidence that's basically audit-proof.
Now, to make that plan of care totally ironclad, the language you use is everything. It needs to basically quote the tax code right back at the IRS. You want your doctor's letter to say something exactly like, I certify that patient name is a chronically ill individual as defined in Internal Revenue Code Section 7702B, and then it should say why, either the issues with ADLs or the need for supervision. Using this precise language is like speaking the IRS's own language. It leaves zero room for doubt.
Next up, let's talk about the actual contract with the facility. A lot of places just have a single all-inclusive fee for rent, and that can be a real trap. An IRS auditor sees the word rent and might just automatically disallow it as a personal housing cost. So the fix is to make sure your contract, or maybe an addendum, says very clearly that the residency is pursuant to a plan of care. When you have that chronically ill certification, this wording links the housing directly to the medical need, and that's what lets you deduct the whole bundled fee.
All right, we're on to our final step, Part 5, making the numbers work. We figured out how to get the expense to qualify as medical. Now, we just have to run it through the final IRS formula to see the real-world tax savings.
So, before any of this deduction magic happens, you have to clear one last little hurdle. It's called the 7.5% AGI Floor. What this means is you add up all of your medical expenses for the year, but you can only start deducting the amount that goes above 7.5% of your adjusted gross income. So if your AGI is $100,000, that floor is $7,500. The first $7,500 of medical bills don't give you a tax break. You only deduct what's above that number.
Okay, let's put this all together with a really powerful example from the source material. So imagine a resident has an adjusted gross income of $60,000, and they're paying $120,000 a year for memory care. Since they are certified as chronically ill, that entire $120,000 is a qualified medical expense. Next, we figure out their 7.5% floor, which is $4,500. We subtract that floor from their total medical costs, and that leaves a final, absolutely jaw-dropping tax deduction of $115,500. And because that deduction is way more than their income, their taxable income is now zero. The outcome? They pay zero. Nothing. No federal income tax. That is the power we're talking about.
So, let's quickly recap the action plan. 4 simple steps. Number 1, get that official chronically ill certification from a healthcare professional. Number 2, get a formal, written plan of care that uses that exact IRS language we talked about. Number 3, look at your facility contract and make sure it connects the residency to that plan of care. And number 4, and this is so important, talk to a tax professional who gets these rules to make sure you file everything perfectly.
We've gone through a lot here, from the new tax laws to the nitty-gritty legal definitions and paperwork you need to unlock this huge tax benefit. I know it's complex, but the financial impact for families is just too big to ignore. So for any family out there trying to manage the high cost of senior care, the real question isn't whether you can do this, it's, can you really afford not to find out if this strategy can work for you?